But we can very clearly see that the pattern here is this is a channel, and it is a bearish channel. You can't deny that. It is a bearish channel of consolidation. So this tells me we probably haven't seen the lows. Just the mere fact that I see the stock market having another leg lower, a substantial leg lower, that also indicates that as a risk asset right now, Bitcoin probably goes lower as well. And so again, 12 to 13,000 is where I'm looking for, probably within the next 6 to 12 months. And then I do think you finally bottom out. Maybe we pierce 10K. It's hard to know where these things bottom out.
After the cryptocurrency market had lost $165 billion from its market capitalization in a week, Bitcoin dropped below $20,000 and is still struggling to pull itself back above that threshold. Back in January 2022, Soloway projected that the cryptocurrency sector might experience a dot-com moment soon, but also predicted that Bitcoin could trade at around $100,000 or $250,000 in the next 5 years. In a recent interview, chief market strategist of InTheMoneyStocks.com Gareth Soloway tells us all about his latest analysis of the charts, as well as his predictions and price targets for Bitcoin and gold. In his opinion, he still believes that Bitcoin might drop further to a low of $12,000. He is also a proponent of crypto regulation, believing that it would be a positive thing for Bitcoin and cryptocurrencies in general, as institutions would feel more confident investing their clients' money in them. Before listening to him, please ensure to smash the like button and subscribe to the channel.
I definitely still think we're in a bear market. The longer term trend on the S&P 500 is still fully intact. Like you mentioned, the July-August high, we still haven't even come up to close to testing that. In fact, let me show my screen here so we can kind of take a look at the chart itself. So this is the SPY, which is basically the S&P 500. And what you can see is the long-term downtrend from the high on the spiders is still fully intact, and we still have a decent distance to go. So for me, as long as we're below that line, the downtrend or the bear market is fully intact. Now, one of the interesting things you can see here is that if you take the 2020 low and connect it to this pivot low, look at how we broke that line, but now we're coming back and kind of testing that area with resistance. So it's a great day on the markets. I think today it's a sigh of relief for the markets. And what I mean by that is, we saw Meta's earnings, we saw Google, we saw Microsoft. It was just bloodbaths everywhere. Then yesterday after the bell, we got Amazon, and that was a catastrophe. And then Apple reported, and it was going down, and then it reversed, and now it's having a big up day, and everyone's like, oh, thank goodness, like we just avoided a major accident or collapse in the stock market. And so now you have a scenario where the big earnings of the trillion-dollar companies are over. The market now is going to focus back on the Federal Reserve, and I think there's this air in the market where the earnings have been so poor that the market is really hoping that this is where the Fed will say, okay, we're still hiking 50 or 75 at this November meeting, but afterwards we're going to take a pause. We see the economic data. We see that the earnings are getting really hammered here. So let's wait for a few months. And the market is craving that pause so badly. So I think the justification is multifold. So number one, I do think that a lot of the economic data is lagging a little bit, like the jobs numbers. We know jobs numbers lag. They've been strong, but I do think you'll see this kind of cliff dive in jobs numbers coming out here soon, maybe as early as next Friday. I do think that if you look at the PPI data, it's starting to show that we're seeing a reduction in inflation. And remember, the producer price index leads the CPI. So producers kind of see the inflation coming down, and then eventually they pass it on to the consumer. So there's kind of this 1-2 punch there. And then I think that the Fed, you have to look at what we saw with the Wall Street Journal article a couple Fridays ago where they kind of said, hey, the Fed's going to raise and then pause as well. And the Fed has used the Wall Street Journal as their conduit to try to kind of give the markets a heads up. And so I think that was important. And I think more than anything, you have these central banks like the ECB, the Bank of England, the Bank of Japan. Their economies and their currencies are almost at breaking points because the dollar has gotten so strong so quickly. So it's not so much that the Fed, I think in a perfect world, the Fed would want to continue to raise, but they have to be careful here because they could literally cause a systematic breakdown in the global system if the dollar continues to get too strong.
Now, what kind of breakdown are you looking for, and how could that impact the markets?
Yeah, so I mean, when we talk about a breakdown like this, we're talking about things like, Credit Suisse. We saw that collapse. I mean, do they just have a bunch of derivatives that just start to go bottom up or turn over and go bankrupt, or go to zero? I mean, you look at certain breakages because there's just so much pressure on these other systems, and everything's been built on this house of cards of cheap money or free money. And so when you raise interest rates as fast as the Fed has done, it's inevitable that there are certain assets out there that can't handle that. Investors are pulling back from the bond market or from bonds. Bond prices we've seen bonds declining because interest rates are going up. The stock market was cratering until recently as well. And you look at other things like what the pound was doing against the dollar, what the yen had been. The dollar yen was just surging as the yen was declining. And so there are breakages that will occur because it happens too fast. And I think what investors don't understand is that if you go back to Volcker raised interest rates. I think he raised from like 12% to 17% in a very short amount of time. That was a 50% hike in interest rates. But if you go to what the Fed did, the Fed raised from a Fed funds rate of 25%, 0.25%, so 25 basis points, to now 3.25%, potentially 4% after next meeting. How many hundreds of percentage points is that to hike things, right? You're talking about hundreds of percent. And that is meteorically more detrimental to the system than what Volcker did, even though Volcker raised a total of 6%. It wouldn't be shocking to maybe head up to 390 on the spiders. That would be around 3,900 on the S&P. I even think 4,000 we could test. But I do think that at some point, and this is going to be what the market's not prepared for, and this is where I see the next big leg lower, and then I'll get to like my really long-term projections. But basically what I see happening is the economy is going to fall off a cliff. And the reason why I say it's going to fall off a cliff is because you've had consumers that have been very resilient. They saved money during COVID. They've paid down credit card debt during COVID. And now they're basically spending that money because, number one, inflation's high, so they have to kind of spend some of it. And partially they want to travel. No one likes being locked down and kind of hunkered down in their home. So they're traveling, they're doing this, they're doing that. But eventually that money runs out. Eventually those credit card limits are hit again like they were prior to COVID. And all of a sudden the consumer is going to be like, whoa, I gotta pull back on my spending, right? And in addition, look at all these publicly traded companies. They're either saying we're going to slow hiring dramatically, or many have said we're cutting 10% of our workforce or 20% of our workforce. And so there's a storm brewing here where, again, the Fed has been going gangbusters on hiking because the data has been strong, but I worry that at some point we fall off that cliff. And the detrimental part to the stock market is going to come when you basically have the economy fall off a cliff, inflation is still pegged. Let's say it comes down from 8% to 4%. But even when we're in a recession, how does the Fed print trillions of dollars with 4% inflation? I just don't see how they can. But the market is conditioned to assume that they will, right? So if you go back to every downturn, the COVID drop, the 2009 collapse, all these things, the market is conditioned to say, okay, Fed, bail us out. Well, we're going to get into a recession, and then the Fed is going to say, hey, guys, we're not printing money. We can't with 4% inflation or 5% inflation. And that's going to be a huge wake-up call to the equity markets. And you're going to see a prolonged bear market. And this is getting into that longer-term projection. I don't think we're going to make new all-time highs for at least a decade. Look at the S&P 500. So number one, look at this monumental run since 2009 when the Fed was printing money. Look at the vertical nature of the market, right? Just unbelievable. Like, even if you go back to the dot-com period here, it still was nothing like we experienced in the last really 13 years. Now, if you want to look at a chart that's very similar in start and see what happened, take a look at the EWZ, which is the Brazilian stock market. So in 2002, the Brazilian stock market had a very similar vertical move to 2008. And then look at what's happened. We have never gone back even close to those all-time highs, and it's been 14 years. And so I do worry that this is the market of the future for the S&P 500, where we do have mini bull markets in the mix, but ultimately it's going to be a long period of digestion.
I know you're very bullish on gold right now, but if you could expand on kind of the price action that we've been seeing right now and your view of it going ahead.
Yeah, sure. So number one, you have to understand with gold is that it's traded in US dollars. So as the dollar has rallied, gold automatically will come down, right? So the key to kind of gauge the analysis on gold and how is gold performing is to say, okay, how much has the dollar rallied in 2022? And the answer is about 20%. Well, how much is gold down in 2022? About 7%. So in a perfect world, gold should be down equal to what the dollar is up. So the fact that it's only down 7% is actually showing you accumulation. So that's a very big positive for me on the longer term here on gold. It tells me smart money is buying in. And then also, if you look at this chart, you had this nice little double top up here, but really what you're doing is you're consolidating inside of this bigger move. So I do think in a worst case scenario, you come down to about $1,550. But again, for me, as soon as you see the Fed saying we're going to have elevated inflation for a longer period of time, but we can't print and the economy is going to go south and all this other stuff, I think that's where gold actually starts to really outperform. If you look at the late 70s into the 80s, it was towards the end of the period where gold really took off. So I think you're in that kind of scenario.
And if we also look at cryptocurrencies, I know you made that famous call of 20,000 on Bitcoin, which was a very dramatic move down. But now you are actually looking for lower prices in the long term, if you could expand on that.
Yeah, absolutely. So my real long term, 3 to 5 years out, I think Bitcoin goes way higher. I think eventually you see this pivot where we get good regulation, or at least regulation, so investors know the rules, right? And that's a big thing to understand for a lot of newer investors in crypto, is that investors, and you'll see this in the stock market, we hate uncertainty. We want to know the rules that we're playing by, and that allows us to make decisions about risk and reward. And so without this regulation, it's really keeping a lot of big money on the sidelines, which makes Bitcoin very, very midterm uninvestable. Now, shorter term, you're going to get little pops if the dollar drops. If we have equities rally, you see the risk on trade come in. But we can very clearly see that the pattern here is this is a channel, and it is a bearish channel. You can't deny that. It is a bearish channel of consolidation. So this tells me we probably haven't seen the lows. Just the mere fact that I see the stock market having another leg lower, a substantial leg lower, that also indicates that as a risk asset right now, Bitcoin probably goes lower as well. And so again, 12 to 13,000 is where I'm looking for, probably within the next 6 to 12 months. And then I do think you finally bottom out. Maybe we pierce 10K. It's hard to know where these things bottom out. But I think once you get in the mid-teens, low teens, for me, it's just starting to slowly dollar cost average in, and knowing that my long-term views are so bullish on Bitcoin. So again, even though I have a 12, 13,000 price target, my worst case scenario is 3,500. I think, again, you'd stop out a lot of people at a break of 10,000. So when you're trading, psychology is a big part of it. So the question is, where do you get max bearishness and people, like the most people, to throw in the towel and give up on it? That's usually the bottom. So the question is, where is that going to be? It's making me think it's more 10,000 or sub 10,000. But basically, the key here is thinking about it like, do you really know? And if your long term is so much upside of 100,000 or 2 or 5 or $1 million, once you get below 20,000, it's really like, okay, well, why are you squabbling over $5,000 when you think it's going to go to $500,000? And do you want to risk missing the trade? So what I like to do, and what I do is, once it gets in the teens, right, and you're getting, within maybe 10,000 of the low, I take a chunk of money, right, and I say, okay, how much am I really willing to invest of my net worth in Bitcoin? And let's just say 100K. And so I'll divide that 100K up into $20,000 increments. And then what I'll do is, at my first buy, it'll just be a very standard robotic 20,000 at, let's say, 18,000 or 16,000. And then what I'll do is every $2,000 or $3,000, I'll just have automatic limit orders set where I'm going to buy a little bit more, another 20,000, another 20,000. And by doing that, even if it doesn't get to my lowest target where I wanted to buy everything, at least my dollar cost average, especially on something I think can go to 100 or 500,000, it's so low at that point. You just have to have some involvement in it because you don't want to miss the next boat, the next bull market. For me, it's really understanding that as much as the Fed is playing the hard game now and won't be able to print money in a recession, if we get to a bad enough scenario like a depression, they're going to stimulate. They're going to go back to what they know best because they're going to see the pain. They're going to feel the political pressure to print money again. And so inevitably, and this is, you can go back in history to the Roman Empire or to other things, this is how they kind of kept their economies on afloat during bad periods. But eventually it's the undoing of the empires. And so if you're looking at something like a Bitcoin, which you have eventually, you have to assume regulation comes, eventually bigger money starts getting involved more and more. Number one, you just get like 1% of pension funds to put that money in Bitcoin. And right there, it's 100,000, if not more. But you start getting some of the bigger money involved with proper regulation and protections, and it's so easy to see it at even $500,000 at some point. Now, we're not talking near term here. You got to give it like 10, 15 years, but at some point it makes a lot of sense as kind of the digital gold. And with a run of only 21 million possible, if it can get taken on as a digital gold, $500,000 on Bitcoin is not outlandish.